Good afternoon, ladies and gentlemen. Happy end of the trading day, close of market, a little bit past close of market for Friday, August 25th, 2017. Welcome to the Friday discussion, our open forum Q&A session for spreads and for spreads questions in our spreads edition. My name is Mike Shupka. Most of you have been listening to me all week for the past 3 days, talking about spreads, different structures, and different criteria, of course, different management techniques as well. I am, of course, the Director of Education here at Power Options. Well, today is part 4 of our 4-part series on the vertical spreads. Today we will take your questions live and address some questions that came through during the webinars and through email, of course, today as well. Before we jump into that, we want to give a few introductions and give a few explanations, not explanations, but a few different discussions here on what's going to happen today. All right. First off, if you're just joining us today for the regularly scheduled Friday open forum and you weren't part of our discussion this week on spreads, what is Power Options? Well, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. Our tools allow you to search across the universe of options to identify only those positions that match your personal risk-reward tolerance. In addition to search capability in over 23 of the commonly used option strategies, we also have tools to help you further research and analyze the stocks or the options, track, manage, and evaluate rollout opportunities for your various positions. Of course, in addition to that, we offer countless help videos, archives, articles, webinar archives to help you get more familiar with the tools on the site and the various option strategies. Now, Power Options, of course, was opened in 1997. That's when Ernie Zerena created Power Options. But everyone here on staff used these tools to trade our personal accounts, myself included, so we have many more years of combined trading experience. Now, although I already have a few questions that have come in, and I have a few questions that I've put together from email earlier today, let me talk about the process and procedures for this afternoon's presentation. I don't have any planned material other than what you're going to determine based on your questions. When you logged on to the webinar, the GoToMeeting, GoToWebinar platform would have appeared on your screen. Inside that platform is a question pod. So just use the question pod to send us a question at any time during the presentation. Again, this presentation is mostly directed towards spreads trading, but I, of course, will do that. We'll address other questions if they come in not related to spreads. Now, questions can be about anything related to options, general spreads questions, strategy questions, trade management, spread specifics, tools on Power Options as well. That's all fair game. We're going to focus mostly on vertical spreads and other spreads today. A couple of basic ground rules. I apologize, folks. Let me just check something real quick here. But a couple of basic ground rules for today's presentations. Don't be shy. Please feel free to ask any questions that you want at any time during the presentation. We're expecting a high volume of attendees, well over 140 registered for today's presentation. I'm not sure if we'll see all 140 here today, but I do ask that you be patient, because with that many people in the room, there's going to be a lot of questions coming in, and there's also going to be a lot of me needing to go through and scroll through and check the conversations as we talk to the different investors and investors comment. We'll get through all the questions, I promise, but just be patient. Feel free to help us help others, of course. If a question comes in and I give a market response, I give a response based on my market experience, what I've done in my personal account, or what I've helped other investors do or seen other investors do. But you have a different way of approaching it as well. You have a different idea for management concept or anything along those lines, please send that to us, and we'll be more than happy to share it with the rest of the audience. Most important, let's have fun and let's get some good education under our belt, which is responsibility on me. But sit back, relax, ask questions as you want to, listen to the questions and commentary that come in, and we'll get some good education for part 4 of our series. Now, to begin, I'm going to start off with a couple of questions that came in through email. At around 1:20, 1:25 p.m. this afternoon, Vijan wrote in and said, I'm in an iron Condor that expires in 3 hours. The short put part, bull put credit spread part of the iron Condor is the 31 strike on UVXY, which is currently at 31.26, and it's been moving all day. Now, should I allow it to run the risk of closing slightly below the put strike price and maybe take assignment, or take action and close now? What do you do during the last few hours? Okay, well, my response this afternoon was, in general, if you haven't closed it already, you're keeping it until the last 3 to 4 hours and you haven't closed it yet, well, you may want to keep watching the position in the hope that something changes or you get a better price to close it out with a smaller loss or perhaps a small profit. When I replied to the email, UVXY was at 31.42. So the 31 put was 42 cents out of the money, so the position might be a little bit safer at this point. But as always, if you're worried about a last moment turn, in the last 30 minutes of the market, you might want to consider closing out if you can get a small profit or even take a small loss, just so there's no more worry. If you're worried about it slipping further, you've held it on to the last day, you don't want to watch it for the last 3 hours. You don't want to worry about, should I have closed it when it was at 31.28, 31.18, 31.27 at 3 or at 2. Close it out, maybe take the small loss or roll it at that point if you're looking to continue to trade a neutral position on UVXY or even a directional, neutral to bull, neutral to bear. Okay? But if you already held it that long and you haven't closed it out yet because closing out at that time would have resulted in a loss, then you may be stuck watching it. Here's a little bit of what I was trying to watch with this, in addition to a couple of other of my positions personally and a couple of coaching session I had this afternoon as well and other phone calls. But at 1:45, UVXY was around 31.42. The 31 put expiring today was about 22 cents. I don't know VJ's total net credit, so I don't know if that was a loss or not. I'm assuming he hasn't closed it because that would have been a loss on the position. Now at around 2:45, it got really close to 31. It was at 31.05 and the put was at 35 cents. Would I have closed it at that point? I don't know. If I was hesitant to close it at 22 and we're at 2:45, if I see the stock drop down to, let's say, 30.90, 10 cents below, but it's at 3.50, it might only cost me 15 or 20 cents, not 35. However, these were highly inflated all during the day. It's 5 cents out of the money with an hour and 15 minutes to go. The midpoint was 35, not the bid, and not the ask. The midpoint was 35. The ask was higher. Okay. Now at 3:45, from that point on, at 3:45, UVXY had pulled up a little bit, but then fell below 31. What I saw at market close was UVXY was at 30.88. So in the last few minutes, it might have only cost 12 to 15 cents to buy to close this, hopefully just at near intrinsic value, which would have been better than the other two prices. So I don't know what you ended up doing with the position, but if you've already held it to around 1:30, 2 o'clock, and you haven't closed it yet because it wasn't profitable based on the net credit you received for the Condor, or just even if you're looking at just the bull put side, if you haven't closed it by then, your real answer is you just got to sit there and watch it. I mean, there's no one answer. There's two answers in my opinion. You can watch it and kind of hope that it plays out. In this case, it didn't. My advice might have not have been the greatest, but in this case, it didn't. It went down below 30.88 or at the close. Okay, so number one is just watch it. Number two, of course, is you're not near the maximum loss. You're probably taking a small loss at one of these points. To not watch it, to just get it off your mind, close it and take the small loss perhaps. Okay, that's the other thing. Just be done with it. Get it out. Didn't work out the way you wanted it to. It's still around the $31 mode, but it did drop below that, but it never gave you a good price, so maybe just close it and take the small loss. Number three, if you didn't want to, you knew you were going to take a loss, or you figured you were going to take a loss in this position, maybe, depending on what your outlook was for UVXY, would be to close the Condor for a loss and then maybe open another Condor for the next expiration. Okay, try to make up what you lost with a new credit on a new Condor for UVXY if you still had the same sentiment going forward. Okay, so this would be just roll it ahead of time to try to stay in a new position and worry about it next week instead of worrying about it in the last 3 hours. Okay, so, all right. Okay, you closed out the UVXY when it was around 3105. Okay, good. And Brian says roll it. Yeah, that would be my third choice, okay, depending on what the situation was. UVXY to me is a difficult monster to follow as well on this strategy also. Let me just take a look at some of the other questions here that are coming in. Sorry, I see some comments. Okay. Okay, good. I just wanted to make sure that there was nothing there. There's a lot of questions coming in, and so we'll get to all those moments. First, though, Brian made a comment about rolling it. It is a good idea. Don't worry about fighting it in the last few hours. If you still have the same sentiment, of course, neutral to bullish, neutral to bearish, or neutral, roll that Condor out to 1 week out or 2 weeks out based on your expectations. Get this off of your mind. Start worrying about it again next week, or not worrying about it with the spread in place. Okay? All right, so speaking of Brian, hello Brian, and of course Sam says hello to everyone in the room. We've got questions from Morty, from Chang, Tom, Jeremy, and more. We'll get to all of you in just a moment. We got to go back to Brian's questions. Brian wrote in about 3:30, I think it was, and made a comment that Priceline, Alta, Expedia all reported essentially great results and the stocks tanked. Okay, please let me know what your key indicators would have been that would have alerted you to this. Okay, there's a problem with trying to gauge earnings, positive earnings, negative earnings, things of that nature. A lot of people say, oh, if you see the stock moving up the day of earnings, it's usually going to drop at earnings. And that's true about 50% of the time. And then others will say, oh, if you see a stock dropping before the day before earnings or leading up to the earnings, it's likely to move up. That's correct about 50% of the time. There are services out there that predict movements based on past movements of earnings. You know, what is the expected percentage movement of the stock 2 days, 5 days, or 8 days after expiration? I'm sorry, after the earnings event is released. But it's not directional. It's just, it could be one direction or the other. So even as you mentioned, Priceline, Alta, and Expedia all reported essentially great results and the stock tanked. It's not so much in relation to the results that's important. It's in relation to how the market's going to react to the results, which is even harder to gauge. Okay? And that's the problem. So from our discussion in the criteria set, part 2 of our 4-part presentation, we always avoid earnings between now and expiration when we're doing the bull put spreads, bear call spreads, any vertical spreads. That's the key. We avoid it just so we don't have that. You can have a great position. You can have a bull put spread that you open that was 20 days out in time, 3 weeks out in time. That had an 80% probability and the stock actually moved up, let's say 7-8% more while the first 5 days in the trade. And now you're up to maybe a 92% probability of expiring worthless. Earnings come out and the stock drops below both strike prices. You're in an extremely profitable position. You may have even been able to close the position for a gain prior to the announcement, and then everything can change in the blink of an eye when you wake up the next day based on how the market reacts to positive earnings, to negative earnings, or anything along those lines. Why take the chance when you're doing vertical spreads that typically have a 10-to-1, 11-to-1 risk-reward ratio? Avoid earnings when you're in the vertical spreads. Okay? And so the question continued. So now, some of these put credit spreads are deep in the money. 2 or 3 legs at various points, but not priced at full loss yet. Not at 100% loss, of course, but many of them are taking big losses. Do I take the chance that the stock will come back, close one closest from the current price and hope the price comes back? It seems like when they're downside, given the risk is almost maxed out. I mean, that's the case. We spent a whole hour and a half yesterday talking about the different rollout opportunities and adjustments one might use based on different conditions. When you're in a bull put credit spread and the unexpected happens, whether it's because of earnings or anything else, and you're looking at close to an 80 or 90% loss of the maximum loss on the position, there's not a lot of management that can be done at this time. You could maybe roll out the spread to try to repair the 450 loss, but remember, you're going to have to do one of two things. You're either probably going to have to go out 4, 5, or 6 months out in time to get a credit close to repair the loss you've taken on this spread, to get another credit that's going to give you back that loss. Or at the same time, you may have to go to wider strikes, a higher margin, to get that credit. So longer term, money tied up for longer, and you might have to use wider spreads to increase the margin. Okay. Once you've hit sort of a 75 or 80% loss, really probably once you've hit a 70% loss on a vertical spread, the adjustments we talk about might not be worthwhile. They might not work. You might just lock yourself into a 40% loss, creating a new spread, rolling it out, or adjusting it to where it can't do that. Now, the question I have for you, Brian, and I don't know if we'll get to it today, you might want to send it to me via email later on, is what are the specifics of these positions, strike prices, and where the stock is now, as well as how much time you have to expiration. Are these going to expire next week? Are they 2 or 3 weeks out in time? Are they September series, or are they October series as well? And Brian did comment here on this. Oh, they expire in a week or two. Okay, Brian, thank you. That's what makes it even tougher. So it might be that you may have to do that. You may have to just wait, okay? And that's what we're kind of looking at also here. Now, you asked a follow-up question, Brian. What strategies do you use around earnings? Well, I've been saying for a few weeks now on our Friday sessions that I've been kind of practicing with, not practicing, Ernie, myself, others in the office. We've been trading long, very short-term straddles, buying straddles, not selling, never selling. Long straddles, buying a call and buying a put the same week that earnings are coming out. So putting on a position that maybe only has 3 to 4 days to expiration and earnings are coming out in a day or two. You get volatility crush, but you accept that. And what you're doing is you're looking for a quick movement on the stock, trying not to pay more than 3 or 4, maybe 5% at most of premium into the underlying stock, and hoping for a couple of the surprises that move 10, 12, 15, 20% in one case on one of mine. Someone asked me last week, when are you going to show the results, or when are you going to show the criteria for that? It's because we're still fine-tuning it. In 6 months, I gained 50%. I'm sorry, in the first 2.5 months of the strategy, I made 50% on the money I'd invested into this trade. 2 months after that, I was only up 30%, and then a month after that, I was behind, and then 1 month later, into this month, I was up again, but only about 14, 15%. So we're fine-tuning it, and the three of us are trying different approaches with real money and real experience to see what works best with that strategy. It is sort of a hit or miss strategy. It really is. I wouldn't say necessarily it's a lottery ticket strategy, but in a lot of cases it is. And David had a comment to follow up to your questions, Brian, there that we mentioned. Let's see. I'm sorry, David. There we go. He said, for Brian F., my experience is that market rarely reacts to results. It primarily reacts to the future expectations. That's very true. The idea David's saying is what you might have seen with Alta and Expedia is they had great earnings for this current quarter. That might already been priced in because the stocks, let's say, were moving up over the last 2 months because they were doing really well. Even though no one had the earnings report, but they were doing really well and people were investing in it and so forth. But then, as David mentions, they'll come out and say, but we think that our next quarter will be lower than last year's quarter and may result in us not reaching our annual expectations of this amount of millions of dollars. We may be just below that based on the next quarter results, and the stock's going to tank. People are going to get out of it because they're expecting a week, 2 months looking forward. So it's usually about the future expectations. That's why you can have great earnings and the stock falls. You can have poor earnings and see the stock rise because it's based on that going forward. Okay? Yeah, and everyone is, Brian commented, everyone is scared to death about Amazon. Yeah, what are they going to knock out of business next is a question, I guess. So we'll take a look at that also. All right. Now, I still have several questions here that came in via email, and I'm going to go ahead, not email, I apologize, folks. I'm going to try to take them one at a time. And to do that, though, I'm going to navigate over the Power Options suite of tools. Okay? I'm going to go to the, let's see if this looks okay. I'm going to go to the big screen there. It's not going to show full too much. Yeah, it'll be okay. All right, so let me go ahead now Here we go. Wait to see if this changes over. All right, so now here we are looking at the Power Options suite of tools. And the first question that came in during the webinars this week, we talked about comparisons of the weekly picks of the day for the covered call and monthly picks of the day and naked put versus results we saw in bull put credits and bear call credits. Morty's question is, when will the weekly pick selection be available for spreads? For bull puts and bear calls, they kind of are right now, just not in that same format, Morty, that we show the covered calls in its own unique tool. If you go into the search under bull put and you click the drop down there to select weekly bull puts, you'll see the criteria that I mentioned during the webinar: the MACD signal over at least 3, stock price over SMA 20, 8 to 17 days, strike price greater than 2, avoid earnings between now and expiration, and avoid indexes and ETFs for this particular screen. Okay, that's what was tested. That's what's available in the bull put credit spread search for weekly bull puts and weekly bear calls. Next week you will see their own links for the bull put picks of the day. We're just going to start off with the weekly bull puts, the 14-day out that we've tested. And Ernie wants to run a few more tests on the monthly. We may put up a monthly bull put as well if it comes close to or starts outperforming the weekly bull put credit spreads. And we'll let you know about that. But right now it hasn't. And this return for the weekly bull puts that we mentioned during the webinars has still outperformed other things that we've run in different ranges. Okay? All right. Okay, now related to our trigger points that we discussed, is a follow-up question from Morty. Related to the trigger points that we discussed, basing triggers to manage or exit a position on the criteria, the stock price being above the SMA 20, a positive MACD crossover, of course, is what we're looking at there, but at least want it to be 3 days. Probability of greater than 75, range out of the money greater than 3, that's not really that important. And of course, if you wanted to set your trigger point for management, if the option premium gets that 3 times or 4 times what your original net credit was, or it's half of the maximum risk. So Morty's question is, how long do you wait before pulling the trigger if a trigger's hit? What if you're in a 14-day trade and the position changes after only 2 days? Would you still pull the trigger at that point? If I'm in a position, I open one of these positions on Monday of next week, whatever comes up in this search, and come Wednesday, the stock changes and drops below the 20-day moving average, because I'm in a bull put spread, and at that point the probability drops to 60. That was one of the other trigger points, because it started to drop here and here, and maybe the range out of the money is at 0.5% now, or let's say 1% out of the money. Now, am I going to close the position now because it's moved against me? No. The trigger point is an idea of when you should look to manage. So I'm going to evaluate the management techniques at this point. I'm going to see where I stand, what my loss would be on the position right now that the triggers have been hit, and then looking at the 1 or 2 that I think make the most sense after looking at the stock and seeing what my sentiment is. Do I think now is the best time to manage it? Is it worth holding on to it and allowing it to take more of a loss? Why is that a good idea? We talked yesterday about the zero, we had management techniques 1 through 7. The zero management technique was do nothing, because if I set it up properly, where even if I took the full loss in that bull put spread that's only 2 days in and it went against me, but if I take the full loss, it represents only 1 or 2% of my total portfolio, maybe I'm okay to let it go. Okay? That's sort of the idea. But remember, when the trigger, we talked about the triggers for the technicals, if the stock's moving around and it drops below the 20-day moving average 2 days into it, I'm still going to look to see if the MACD is a second verification. I rarely will close it if the stock just drops below the 20-day moving average. I'll wait to see if the MACD has a negative crossover and the stock has dropped below the 20-day moving average. The probability one, yes, I pay attention to. If the, we open this with a delta of 0.25 or probability of 75, but the delta goes to 0.40 and the probability goes to 60. Remember we talked about yesterday, I have to look at it almost with fresh eyes right now. What happened? Why did it pull back to where the probability dropped and the delta increased? Why is the stock falling? Is it outside market conditions? Is it weakness in the sector that just came out of nowhere? Or is it something else in the stock that news came out and it's just poor guidance? Okay, all right. That is all the question. I mean, that is really what you're looking at. So do I wait? I don't have a time frame in mind to wait, and I'm not going to just go ahead and pull the trigger automatically. I have to reanalyze the position, and part of that analysis of the position, that reanalysis of the position, in addition to looking at why did this fall happen, or why did this change happen? Again, is it broad market conditions, or is it just something that came up out of nowhere? Then I'll say this is the trigger to mean I should potentially look to manage the position. I'll look at the management. If I can't find a management I like right now that puts me in a better position, maybe I do nothing. Number 0, leave it open, because if I practice proper position sizing from the beginning, even if it continues down, I take the full loss, my portfolio will be okay. All right. Terry asks a question. Let me see. Terry, I'm going to get to yours next. I just wanted to scroll down here and look at something else while we're talking to Morty. I know there was another question that came in. Okay, and just following that. Okay. This is a question that did come through via email this morning that I meant to include and I didn't, and thankfully Morty just asked the question. We talk about how spreads are risky. We're trying to give you education, give you guidance on criteria of what we've seen worked in the past. Let's all keep in mind one thing. Spreads are risky. Why do I say that? You know how much money you have at risk on any one spread. It's dialed in. So how is that risky? Wouldn't you consider that more conservative? Oh, this is a bad spread. Let me just change the numbers here. All right, let's just do that. There we go. Looks a little bit better on the profit and loss chart. Well, here's a 10% return. A 7.5 point spread to make 68 cents, a 10% return for about a 7-day trade, right? What do we know about this 682? Exactly what Brian F. experienced today. Although I know that I'm only risking 682, so if I did one contract, it would be $682 at risk. If I did 10, it would be $6,820. What do I know about that? I can lose 100% of that. Black swan event, market correction out of the blue over the weekend. We wake up, all the indexes are down 2%. It'll pull all the stocks down. BABA might be down at 150, and I'm suddenly at a maximum loss in the trade. And again, can I manage at that point? No, not really. I mean, there's no real management I've seen once you've taken near an 80 to 90% loss in your spread that's going to help you turn the losing trade into a winning trade, other than continue to trading it for more time. Or if you practice proper position sizing, take the loss, 2% of your portfolio, make it back with other trades that look better. Okay, but that's related to the question, but not Morty's direct question. Morty's direct question is that if you recommend only investing up to 10 to 20% of your funds and spreads, which I do, because you can lose all of this. You know, I had a conversation with a customer this morning. They said, well, what if I only have $5,000 to invest right now? Should I put all $5,000 into spreads? Well, if you open 3 spreads on Monday that are 1 week out or 2 week out, and a market correction happens during the next 5 days, you could lose 100% of what you have in that spread. You could lose all $5,000 or close to it if you're just in it bad timing. If you picked bullish, a black swan event, the market pulls down, all 3 trades are at 90% loss, you lost 90% of your portfolio. Okay, so that's why you should speculative positions, buying long calls, which can also lose 100% of their value, or long puts 100%. The spreads the straddles I'm talking about for earnings, only do it with about 10, 15, or 20% of your portfolio. Whatever you're willing to stop and say, I might be okay if I lost that amount. That's why I say 10%, personally. Okay, but Morty's true question is, if you're only allocating 10 or 20% funds, where was you just allocating the remainder of your funds within the worlds of options trading? Well, you've all heard me say this for months and months. My personal portfolio at any given time over the last 6-7 years, 50% of it is in conservative protected position, married puts and collars, standard collars and radioactive trades, a combination of the two. Then I've got 10% to 15% in credit spreads, debit spreads. I've got 5 to 10% in diagonal calendar spreads, which looking for longer term growth further out was still generating premium short term. And I've got about another 10 or 15%, really about 10% of my portfolio playing with these speculative positions, these long straddles, or buying calls and buying puts. All right? So what it really comes out to is about 90% of the money I have allocated of my account to options trading. 50% of that is in protected positions, kind of boring, but safe, very safe. About 15% or so I'd say is in the spreads right now. Well, okay, I could say 20%, 25% is in spreads if you think vertical spreads that we're talking about, the weekly bull puts, bear calls, and others, and including the calendar spread portion. Little bit different play, it's longer term growth, but yeah, that's in there too. And then another 10%. 10 to 15% on these long straddles around earnings. That's what I have right now, plus a couple extra long calls I have hanging out that I don't have a diagonal on, but they're really designed to be a calendar spread. This relates to something that we wrote on our blog a little bit back. I'm going to try to find it for us. I had the link earlier. But it's a blog article that Ernie wrote, and I know it's back. I can post the link in a second here. We'll probably come back to that later on. But it's related to what's called the barbell strategy of investing. And what the barbell strategy of investing initially stated was 80% of your portfolio should be invested into safe things such as CDs and others, and then the 10 to 20% that you're using should only be in speculative positions. Okay? Here it is. A balanced approach for portfolio success, the barbell approach. So the original write-up was 90% conservative treasury bills and 10% speculative high risk, high reward. Well, we figured that if you're trading with 50 to 60% of your account with protected positions such as married puts and collars, that's pretty much conservative treasury bills. You know you're not going to be able to lose more than 3 or 4% on each of those positions, and it shouldn't represent more than 1% of your entire portfolio. All right, then that's the setup that we use. That's the conservative side. So you can still be active trading options, but in a protected position. Then the 10 to 20% range, speculative. Credit spreads, long calls, straddles on earnings, and so forth. So let me send that link to everyone there. That's the balanced risk reward, what we call the balanced approach for portfolio success. That's why when we're on the webinars and I say that was my allocation of 50 to 60% in married puts and collars, and then 10% in some of the outside spreads and more, that's what we're looking at also. Okay? Okay. Question here from Brian. I'm going down to the comments that are coming in as I'm talking and then going back up to the questions, so bear with me. Brian says, can't you properly diversify or use market hedges? Well, okay, here's another thought on that. Remember when I said you have $10,000 total to invest. Not $10,000 you're investing to options. You have $10,000 to invest, and you decide you want to do credit spreads. And you think, well, I'll be okay. Let me go ahead, and I'm going to find 10 bull put spreads. I'm going to do 10 contracts of each for $10,000. But let me do 9 instead, save $100, and then let me buy puts on SPX, puts on SPY, or buy calls on the VIX as a market hedge. So instead of doing a few positions with multiple contracts, I'm going to use smaller contract size, and I want to do as much as I can, 9 positions on my $10,000. Okay? Another write-up that we have here is portfolio or market insurance. And where am I talking about with that? What I'm talking about with the portfolio insurance, stock insurance, individual insurance, or portfolio insurance, is that I can have a portfolio of 10 bull put spreads and put money aside to buy puts on SPX or SPY in case the market goes against me. What can happen? The same thing that happened to Brian. He could have been in 3 positions. Now, I know we avoid earnings between now and expiration, but you could have been in Priceline, Alta, Expedia, and have all of them drop. And the SPY is still going up. The QQQ and the NASDAQ might still be going up. So the puts that you bought are losing money because the market as a whole isn't dropping. The stocks you selected are. And remember, if you're trying to structure a portfolio and you're trying to diversify, whether you're bullish or whether you're bearish, the stocks can react differently to market conditions. So sure, if the market falls, your bear call credit spreads are going to look great. But if you take a 50% loss on one of those spreads, you're wiping out the gains of the 5 previous others. That's the lie of leverage. Okay? Just a simple portfolio, even the one I tested over a 2-year period, okay? The bull puts we tested, the criteria we tested, it had a great endpoint. But because it's leveraged, just like any other leverage strategy on the position, what you'll end up seeing is that you're going to have highs and you're going to have lows. And one of the examples I was running that was actually a successful bull put credit spread result over a bullish 2-year period was about a 35-36% gain over 2 years. Not fantastic, but still pretty good. Okay? Well, it wasn't as fantastic as the others naturally, but it was still pretty good. But that portfolio had a drawdown of 71%. $10,000 allocated to that trading dropped down to a minimum amount of $2,900. Now, if you stayed in, you would have been profitable, but how many of us would have stayed in watching the money we set aside to allocate to spreads drop below 50% of its value when we started trading? It's a tough pill to swallow. That's why we kept working on the criteria, so that you might experience a large drawdown over a 2, 3, 4-year period at one point or another in a bad market, but it wouldn't be that bad and you'd be able to make it back up. Okay? Terry asks a tough question. This might relate to the UVXY position as well, but let's just take a look here. Terry asked a tough question. With a put credit spread, or any credit spread really, should we buy back the spread if it is in profit on the last day? What is a profit? Okay, that's the real question. And will it help you long term? Okay, so this isn't a great example. Let's grab another example, and I might even use UVXY for Terry's comment. Terry's question here. Okay, so let's go to UVXY and let's clear these out here. We know what we saw, but let's go to this position. It's at 30.88. It's a 30.50 put, 29.50. Let's just take it as a normal credit spread for a 1-point gain. We'll say we sold this one for, I'm sorry, 25 cents. And we bought this one for 11-cent net credit, okay? So 12.4% return. Now I'm just using this small number as an example. Now this is for next week. And let's say next week, remember we're at the 30.50 strike here and the stock's at 30.88. And let's say the stock happens to stay here on Friday. But what we saw with UVXY is even at one point today with 2 hours to expiration with UVXY at 31.42, it was still about 28 to 30 cents to buy to close the short put. It was still expensive. So let's say it actually drops closer. Here we are at 30.50. Let's say it drops to 30.68 next Friday. And let's say the market maker is putting in a bid of 22 and an ask of 24. Now naturally, at this point, I'm not going to buy it back because you're taking twice the loss. You're taking a 25% loss on the position, even though it's still out of the money, and it may still end out of the money as well. Okay? Now, let's say that the stock stayed at 30.88, and it's a 0.07 bid and a 9-cent ask on Friday of expiration, and we're thinking 8 cents of midpoint. Okay, so now we can close for a profit before expiration if we're worried about it dropping below 30.50. Kind of along the previous discussion we had with Bijan. If I don't want to think about it and I can make a profit, sure. But remember now, depending on how many contracts you traded, what your original net credit was, and closing this now for 8 cents means I'm making a 3-cent profit. Okay? So on 10 contracts, calculate that and factor in the commission costs. 20 contracts, factor in the commission costs. Would it be better to leave it open? Now this is a personal preference thing that was mentioned before. We could put a stop in. Sam had mentioned that earlier on Vijay's question, that if I'm not sure where it was, could have put a stop on the stock or a contingent order to close out of the spread. But you can also just watch it and see where it goes. No one wants to spend the time doing it, but sometimes that's what we have to do to maximize the profit if we're holding it through expiration. But in reality, what it comes down to, Terry, should I close it if I have a profit the day of? It depends on your confidence going forward for the next 2, 3, or 4 hours to market close. And it also depends on, is this profit really going to be a profit after commissions, depending on your premiums, depending what was originally taken, and are you talking about a profit of, you know, half of what you expected, a third of what you expected, a fourth of what you expected, or are you talking about a profit that's 60 or 70%? One of the rules we did discuss, I believe, in the first presentation is the 80-20 rule. If I've made 80% of what I expected to make in the position, then I may go ahead and close it out. But if I'm holding it to the last day, I'm worried about what would happen, sort of what we were looking at with Vijay's question earlier, what will happen going forward. Should I close it for a profit? Potentially, especially if you don't want to watch it the rest of the day and you're not planning on rolling it forward and continuing the trade, okay? But what is that going to be? What is that outcome going to be on that spread position, okay? Is a profit really a profit when you factor in the extra commissions and more, okay? That's what we get down to. Okay. All right. Oops, sorry. I was just looking at a couple of things there. Brian says, are these tools iPad friendly? Yeah, they should work on any browser. We don't have a specific app. And then Brian also asked, can you talk about the, I forget how you phrased it, but the hedge risk there, the moneyness, that's another problem, all right? And what do I mean by that? If I'm diversified into multiple spread positions in my portfolio, and we think diversification is a better way to go, remember something else. There's two things to remember. Number one, what happens when you diversify? Well, the losers don't impact your portfolio as much, okay, overall. Guess what? Neither do the winners. That is why in the testing I only used allocation. When I used the $10,000 allocation, I only allocated 30% to each spread. Okay, and only did 3 spreads because I tested it with 5 spreads and 10 spreads, okay, allocating 1 or 10% to each and 25 and so forth. And the 3 spreads outperformed, all of them, because the returns were muted when you go to too much diversification. In addition to the returns being muted, yes, some of the losses were muted, but it wasn't as profitable. Okay, so what we tried to do is maximize the return while also maximizing how much effect the losses would have as well. All right. Chang, is it Chang? I'm sorry, Chang. It says, during part 3 of the webinar, I wrote down an original bear call credit can be turned around just by rolling the long call. That's correct. Okay. And he says, I don't think I understood this. Can you elaborate? I think that was your fault. The problem was that while you were writing that, Chang, 2 questions popped in. Okay. Okay, I'm not sure if I understood that. Can you please elaborate? Let's use this as our example. 3088. Sorry, folks. 1 second. So we're just going to stick with UVXY today, but we're going to change the strategy. We're going to go out to next week, and we're going to say what had happened if I had sold the 3050 call and bought the 3150. I'm not going to use these prices. Oh, okay, I'll use these prices. Let's see what we're at. Okay, so 17 cents, a 1-point spread, and now this is stuck here. Okay, and in part 3 of the webinar, I said that by rolling one leg, the long leg, I can convert the bear call credit spread potentially into a winning bull spread if I think the stock's going in the opposite direction. Now this one is a bad example if you look at it technically because it's dropping, but we're going to say the opposite. Let's say we were in this position and we were bearish. We sold the 3050 call, bought the 3150, and net credit of 17 cents for a 1-week trade. And now the stock has moved up over the last 2 days and is above our short call strike price. We call it the pendulum adjustment, the 7th adjustment. And what it means by that is maybe I can just sell to close this long 31.50 and buy to open a deep in the money 29.50, and in one move I've converted a bear call credit into a bull call debit. It only works, of course, if the debit between these two minus the initial net credit is less than the new difference in strike prices of 1 point. Okay, so let's synthesize that. How would that work? Again, it's being threatened. I want to do one move. I'm going to sell to close my long 31.50 and buy to open a 29.50 call. Okay, so let's go ahead and sell to close 31.50 that we bought. And I'm going to say, let's make some profit on it. Let's say it went up to, cheating now, I know, but that's because I just opened this position brand new. But I'm going to, check my position. After this, we'll check my position. Okay, 185, lucky. And then we say we're going to buy this 29.50 at the current price. Well, did I do a 25.50? No, 29.50. Okay, so what just happened here? Now, these aren't actual prices. Remember, we got in originally with a net credit of 17 cents. We had a bearish spread where the stock had moved above the short call. We sold to close the long call here, left the short open, and moved it down to the same strike difference to create a bull call debit. And in this case, the bull call debit, the debit to roll, the cost for me to roll would only have been 55 cents? Yeah, 55 cents minus the 17 cents I keep. So my debit into the spread is $38 on a 1 point spread, so I have the potential to make 62. And normally the potential return on that maneuver won't increase the profit. It'll usually lower the profit. This was originally a 20.7% spread at 17 cents. Rolling to this might give us a bull call debit with a max profit of 10 cents or 9 cents, something along those lines. It's still a profit if the stock continues to go up, where we'd have more of a loss on the bear call spread. So you sell to close the out of the money call and you roll it to a slightly in the money call below the short. You don't touch this. This is your pivot point. You swung it from here to here, a pendulum. That's all you did. And that converted you from a bear call credit to a bull call debit, which can be profitable to the upside if the stock continues to go in the long direction. Save some commissions from closing the bear call and opening a bull put spread. Okay, it's just one move down, one commission to roll, or whatever your roll commission is, and that'll get you into place. Okay, it's called the pendulum adjustment. If you want to, you can, of course, let's take another example very quickly. Well, by the way, I'm sure everyone knows this by now. Usually we're scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time. I highly doubt we're going to close at 5:30. We're probably going to be here till 6 o'clock, so I get through the questions, and I apologize for that, but we knew how many questions and comments were going to be coming in as well. So let me just go through this here. Yes, there's a comment there. Okay. And what I was going to do is go through. Okay. Whoa. Sorry, folks. No problem. No worries here. Not a worry at all. Just seeing a lot more question comes in. Okay. And that's a good one too. But what I want to do is, from our webinar the other day, I want to go back in the portfolio. Let's look at another example. We did this during the webinar. This is still a losing position. Oh, shoot. Darn it, it's not a losing position anymore. The BABA moved down again on the bear call, so now it's actually profitable because it's below both strike prices. But this is the one we did when the stock was at 175, and we showed rolling the 177.50 long call down to the 167.50. Okay, I'll show it anyway, but I doubt it's going to be necessary to do, because this one's still out of the money. So here's a bear call. Now yesterday it was between the strike prices, so what did we do? We sold to close the 177.50, bought to open the 167.50, and paid a debit. Well, it's $1,200 for 10 contracts. I think we paid a debit of, what was the debit? Oh, it's a 5. I can't remember what the debit was. I think it was $680. It ended up being, no, it ended up being a debit. Oh, that's right, it didn't work. It ended up being a debit of $620, but we were only in a 5-point spread. So it wouldn't have been profitable. We would have lost $1.20, which was less than we were losing at the time to liquidate. But in that case, it wasn't profitable. It was a bull call debit spread that was, negative the entire time. So the pendulum adjustment didn't work. But that's what's called the pendulum adjustment, is you sell to close the long and your bear call. Usually works best when the stock's between the strike prices, and you buy to open the one that's the same distance away from the short option, the pivot that you don't move. So you've got a pendulum swing. You just took this one, swung it this way. Now you've got a bull call debit, which might still be profitable. Now the stock has switched from bearish to bullish. Okay. Chuck says, can you explain how to set stops on spreads? Well, there's multiple ways, Chuck, to set stops on spreads. It depends what your broker allows you to do. Some brokers will allow you to put stops on a strike price. Okay, so you can say, well, if the stock hits 172.50, enter what's called a contingent order to close both legs of the spread. Now that can be risky. Why? Because as Morty mentioned earlier in the presentation, if I open this position today and a day later the stock goes up to this price, it's going to be very expensive to close out the spread. It's not going to be the maximum loss, but it's going to be very expensive because I've only been in it for a day or two. I don't have any time value decay in my favor, but usually you want to close them both. Okay, a contingent order. That's what it would be called. You put in a contingent order to close the spread if the stock hits X or Y. There are brokers who allow you to, whoa, sorry folks, my apologies. There are brokers who allow you to put stops on the price. So let me clear this up and just use one contract on this Alibaba spread here as well. Let's take it down to 1 and 1. Okay, so net credit of 120. Excuse me one second. Fantastic. All right, so it's $1.20. And I want to close out if the liquidation value, the debit to close my credit spread, is 2 times this. Okay, so that would be 240 on the spread. Now, this is a rare case. In the webinar, I said 3 to 4 times, but this is a high net credit of a 31.6%. I wouldn't put a stop at 3 times the net credit because that's the maximum risk. Just let it take the maximum risk. But if I put it at 2 times, I'd put a contingent to liquidate this spread if the debit to close is equal to 240. And again, you could put it on the stock, say put a contingent order if the stock reaches 172, within 50 cents of the price or within 1% of your short call strike price. Depends on your broker. Check with your broker, see what stops they allow you to put in, and as we discussed, you can put in stops for the credits. You could put in a stop for the stock price itself. By credits, I mean, of course, the liquidation debit on the position. And that's why in the webinar I referred to those technical indicators. I can't set those technical indicators, okay, on my broker. But most of them I can set here at Power Options. So if the stock falls below the 20-day moving average, that's the trigger. It will alert me to that on my portfolio, and I'll look and see what I can do with the management technique. It's not a hard stop, okay? It's close. When I see a trigger, that's when I want to do that. And following up with the trigger and stop concepts about an hour ago, just 10 minutes less than an hour, David wrote, in the Great Spreads Trade seminars this week, you identified multiple trigger points for initiating management. Can you help identify how these trigger points can be entered as alerts in Power Options? Sure. Okay. The main ones that I use, of course, I discussed. Oops, sorry. All right. So let's go. Right there. Okay, so let's take our bull put credit spread on CMG, David. Now, there's 2 ways to do this. I'll go into the view. And remember, in this position, I sold the 300 put and bought the 295. One of the alerts I discussed, of course, is the 1% rule, or with using weekly options, the 0.5% rule. So I'm going to want to be notified if the stock drops to within 1% or 0.5%. So I'm going to put in 301.50. That'd be 0.5%, and that's a red warning. That's the stock price limit. Days expiration, I put that in. These ask time value limits on the individual options, don't worry about, but the percent position change. Okay, this takes a look at the total net credit of your position, and in this case, oh, this wasn't the 120. I'm sorry, this was the 90 and 1. This is 75-cent net credit. So I want to be notified if the position, the debit to close, reaches about $1.50. So I'm going to go ahead and say, you know what? I want to be notified if the decrease on this position is at 100%. It's not 50%, it's actually 100% on the value. Okay, so I'm taking in 75 cents. I want to know 100% loss when this goes to 150, which is twice the net credit. Or I could go 3 times and put it in at 150. Here's the SMA, stock price less than, this is a bull put, so I'm going to put stock price less than SMA 20. Let me go ahead and save alerts. Now, nothing's going to happen. I don't think any of these are triggered, but that's where I'd set it. That 1% rule you set with the lower and upper stock limit. You can put in a change in stock price. I don't normally do that. The position change based on the net credit that you received. And then, of course, the stock price range if it's below the 20-day or 50-day moving average. I'm always trying to avoid earnings between now and expiration as well, so I'll set that also. All right, hold on 1 second, folks. I apologize. There we go. Okay, so now alerts are set. One of them actually did trigger, it looks like. But see, there's my new lower stop limit now on the portfolio for the position. I see alerts been triggered. I go to view. And of course, okay, because this was the opposite one. That's right. This was the opposite spread. So now it's telling me my stock is below the SMA 20. It's at 308. So my trigger's hit. What do I do now? Well, I know I have the 300 put and the 295 for 7 days to expiration. I'd look now and check and see if the MACD crossed over yet. Did I get a double verification on this where I might want to look to manage the trade that looks like it's going bearish? You mentioned the probability. One of the views in the portfolio is the Greeks view here. So I can see the probability shift. Okay, the probability this would be in the money is 23%. I'm having the programmers change that. Ernie did this for covered calls and other positions. You just do it minus 100. So it's still, our short put's still at a 77% here. But this one's only at 55 on BABA. So that's a question mark here. But I can see that right in the Greeks view. Or, the delta if we want. Okay, so we can look at that value and see the sum of our portfolio on the positions. Okay, so it's in the alerts column, it's in view. You've got your technicals here for the stock being below or above a 20-day moving average, position change, total increase or decrease if you're basing it on the net credit, the 1% rule, and then at any time you can view the Greeks right there on the main portfolio view as well. Okay, so David, that's how we take a look at that. All right, let me scroll back down very quickly here. I'm going to try this. All right, let's see here. All right, okay, real quick, I was looking at some of Sam's comments. He was talking about the UVXY position, and one of the things he was saying is that, rather than rolling out and looking at a new iron Condor, going back to the previous discussion earlier on, it might not be a bad idea on UVXY to take assignment on it because you can convert it to a covered call and there's a lot of good premium. But most of the people here who are doing spreads might not want to be into the stock position and allow assignment. Sam was also commenting on the BABA position we were looking at a moment ago, just saying that I had a debit on BABA when the stock's at 169, did a debit at 170-180 spread and got out when it was 176. Yeah, it's a different, he's doing a debit spread that's out of the money, of course, with that strategy. It's one of the things we kind of talked about there as well. All right, Brian brings up a good comment, and he brings up a good comment. It was part of the discussion we were having before, and I'm sorry to be bouncing around, but I have to go down to the bottom of the questions to the beginning of the questions to get all the questions in order, but then all the comments are coming in at the bottom. GoToWebinar doesn't give me a good way to filter that out. That's no problem. So Brian's going back to our conversation on the spreads, and let's see here. You know what? Well, I'll do this. Let's do this real quick. It's not going to be an apples to apples comparison, but I want to take a look. But here's Brian's question. I know a lot of you are thinking about this too, and I'm relating all this based on what I saw personally with performance, with historical testing. Well, Brian says, if you equate selling spreads to selling insurance products, laws of large numbers should kick in. More trades, smaller positions, all deep out of the money should be more stable than a couple of trades where one or two go wrong. That's not what I saw in my testing. The reason why is the same reason, Brian, I mentioned in the webinars, why it seemed like in theory. Now, I'm surprised about this because it went against the theory of options. When I set out and was testing the 2-week out time frame, okay, and I'm going to follow up with Andrew's question on that because it relates to this. But anyway, when I was looking at the historical testing, and I set it to 2 weeks out, and I said, okay, I set it this way, and I prefer the $2 spreads are different, and I had a hunch that they would outperform the 1-point spreads or lower, which they did, with the same criteria. But at the same time, I figured, well, by the laws of large trades, by the laws of what you're talking about, and in addition to the fact that just by the rules of options, if I go week by week by week, if I trade every 5 days, I should have a much higher annualized return on my positions than if I trade every 2 weeks out in time. The annualized return is always higher by selling shorter term, okay? And that should be true. When I took this same exact stock criteria over the same 2-year period and did every Monday open new trades that were only within 6 days to expiration, so we were opening the trades on that Friday, what was a 56% return over a 2-year period with using the 2 weeks out was a negative 72% loss. Same exact stocks. Shorter term. 2-point spreads are higher. Going week by week. This should have been a higher annualized return by the theories of options, but it went from a 56% gain and over the same 2-year period was a 72% loss. 248 trades compared to 142. Why? Because of the lie of leverage. That's what's missing sort of in the insurance. Meaning that, yes, I know what you're saying. Once you get hit in the insurance company or you take a hit in insurance, you've got to pay everything out and maybe declare bankruptcy if you're the insurer. I understand that. But what was happening is going 1 week out on 2-point spreads with a 75% probability, you're looking at net credits of 8 or 9 cents on a 2-point spread. You are also, in order to get this 8 or 9 cents, you're only 2% out of the money. This relates to that expectations I talked about in the beginning of the Part 2 webinar. What should your expectations be if you're going 1 week out, 2 weeks out, 4 weeks out, or more? Okay? Remember, we could get a 75% probability 2 weeks out and be 3% out of the money. Why is that relevant? You have one stock that moves 3% against you, and you take the full loss of 2 points. Your average net credit is 8 cents for 4 or 5% gain every 5 days. You just wiped out 20 previous gains. However, I collect 20 cents, 22 cents, going 3% out of the money on a 2-point spread 14 days out. One trade goes against me. I've wiped out 9 previous trades, not 20. Or if you collect 5 cents on a 1-point spread for 5 days of trading, one of those trades goes against you. Again, you've wiped out 20 previous trades. You get 9 or 10 cents on a 1-point spread 2 weeks out, 3% out of the money or further, you take one loss, it only wipes out 9 trades. Okay, that's where it came into play, and it was surprising to me because, by the way, that goes against the rules, the laws of options. That if I go week by week, I should have a much higher annualized return than going month by month or 2 weeks out. But then the structure kicks in, and the structure was you suffered more losses actually with the 1 week out because you weren't as far out of the money. And when you did take a loss, not all the losses were 100%, but you did take a 100% loss, it wiped out 2 or 3 times as many trades as a loss on the 2 week out cycle would have. That's what it started to perform. You're going to see some write-ups potentially on this. You're going to see more write-ups on that in that analysis, okay? And Andrew commented in a little while ago, it's similar to this idea about hedging and risk and everything, and he's got a point too, and I mentioned this in one of the webinars. We're talking about maybe 10 to 15% of my total portfolio is going to be allocated to spread positions, right? But not all of them are bulls. I'll be honest with you, okay? In the last 15 months, 90% of them have been bulls. But I'll open bear calls too, using that search looking for stocks in a downtrend if I'm nervous about the market. And I'll buy calls on the VIX to hedge against a portfolio, or SPY, puts on the SPY. But that's the idea. I'm sorry, what he was saying there, what Andrew's saying there is that why not be a bulls and bears both and go neutral? Well, if you want to go true neutral, just open an iron condor. Do the bull and the bear. I stopped doing iron condors. I believe I spoke about that in webinar number 1. Both Ernie and I stopped doing straight iron condors about 3 years ago, right when this bull run started, because at the very beginning, we were getting sick and tired of closing out the call side for a loss and having to manage it. Realized that we should just do the bull puts and let them run. And that worked. And that was working. Of course, there were a couple hiccups. I did do some bear call spreads on the indexes over the last 2 years or so. And when the market does turn, when I see that market sentiment indicator go to a sell or a strong sell, I don't think we're there now, neutral, you know, the market sentiment here, when I see that go to sell to strong sell, I'm going to start moving some of my bull puts to bear calls also. Okay. Sam's comment on that. Oh, okay. Sam commented, I'm sorry, is Harvey affecting anyone? Be safe and go to a safer place. Thank you, Sam. That slipped my mind. I should have said that, and I appreciate that you did. So those of you that might be down near Texas, if you're going to be affected by Harvey, then I hope you're in a safe place, and I hope you're doing well also, okay? Let's see here. For later on, Terry had to leave the presentation, and he left before I could get to his question. Just making sure my volume's still in there. Let me check my audio. Perfect. All right, Terry, I'm sorry, Terry. He did leave, but he said, Options Express will not allow me to make a 3-legged trade. I'm at level 4, and they will not let me go to level 5 where I could. Account value is only $6,000. Do you think is OX being overcautious with my money, or are brokers the same? Depends on what 3-legged trade you're attempting to do. Okay, it sounds to me like you're trying to do a ratio spread, in which case I will say that most brokers are going to be close to the same, Terry. And I know Terry's not here, but this is for when he views the archive later. And what do I mean by that? When we take a look at this Alibaba position, and you know, at level 4, you should be able to do, depending on your account size, naked options, if I believe you're over 500,000, is it now? I can't remember the exact number. But looking at this spread, we want a little bit more oomph, so maybe do a 3-legged trade that's a ratio and sell 2 to buy 1. And let's get a little bit more credit here to make this a worthwhile position. There we go. All right, so here's a terrible example of a ratio call spread. Let's bring this closer in. Sorry for the scrolling, folks. We'll be right there in a second. Let's set this up a little bit different. Mine's September 8? Oh, I am. That explains it. Okay. 60 and 155. It's good. Good. Bad. 1. Okay. Which one still? There we go. There we go. All right. So this is not doing what I want it to. Selling 2, buying 1. It's just not showing the proper. Because I have it reversed. Let's just do this right. All right. So let's say you're doing a bull call debit spread, but you want to convert it to a ratio call spread. Okay? And you're going to sell 2 170s and buy 1 165. Autofill. I'm sorry, folks. Thank you. Perfect. Ratio call spread. If you're trying to do this type of 3-legged trade, Terry, because you want the low risk to the downside on this ratio call or ratio put spread, keep in mind that you're in a bull call debit spread with a naked call. Your broker doesn't see this as a spread. Most brokers will literally see this to their needs and their concerns as a bull call debit spread with a naked call. And as I mentioned, most brokers will not let you or not qualify you for the highest level of trading of doing a naked call unless you have a high monetary value. Some might think it's 500,000, some might be $1 million now. some of the older guard might be $1 million. So they won't let you to go level 5 unless the account size is 500,000, because this is, you can say, oh, this is a safer trade because the probability of the stock being anywhere in this area is about 98%. They've got to cover their margin and their cost for the 2% of the times that something else happens. They will not let you do that with $6,000. And you might not be able to do the ratio put spread in that sense with that amount of money, because the ratio put spread would be reversed, of course. We'd have a little thing here up and then the risk down here. And you say, well, that's nothing more than a cash secured naked put. Yeah, but you have to have the cash to cover that naked put, and you're in a bear put debit. So the bear put debit's not the issue. It's the third leg that's causing infinite risk to the upside. They're going to want you to have that higher monetary value in your account, especially I know Options Express does, Fidelity would, E-Trade likely will. I'm not positive on Thinkorswim or Interactive Brokers, but I can almost guarantee you that they're not going to let you do these ratio call, ratio put spreads where you have infinite risk to the upside. You can argue it all day long. They don't care about your arguments. What I mean by that is they don't care about your arguments about how well you know trading, that the probability of it going anywhere here where you'd suffer a loss above $4,000 or $3,000 is probably less than 1%. They have to play the moneyness of the 1% or they're on the hook for it. They don't want to be on the hook for that. They're not even going to take the chance. Okay? So that's probably why you're not getting the level 5, is because account size. When you're looking at three-leg trades, in this case, where you're selling 2 and buying 1, they're probably not going to let you do that. You should be able to buy 2 and sell 1. Because if you're at level 4, if you're looking to buy 2 calls and only sell 1, sort of like the back spreads, well, just fake them out. Do your bull call debit spread and then buy an extra call as a long call. It might cost you an extra commission, but it's the same ratio back spread where you've bought 2 and sold 1, but it doesn't count as a 3-legged trade. You just entered it differently. But you can't do these, the standard ratio calls where you're selling 2 and buying 1, because you don't have the monetary qualifications to cover their risk assessment. Okay? That's why we're not seeing it. All right, so let's go back up here. Oh, Chang had asked a while ago, he had to leave, but Chang had asked, can you put together a discussion on earnings weekly? Yeah, when we figure it out and we're comfortable with it as well, we'll take a look at that for that. There's another things that'll be coming up also. Okay, Sam, other earlier comments, he'd had profits on UVXY. He says market is flat with no real direction. Yep, we're going to see what happens next week as well. In relation to that, market was pretty flat here. Just going through, so I know I've got a couple more questions from Brian. I've got a couple more questions from Jim. Is it Jim? Okay. All right. Okay, so going back to Brian's question, related to, by the way, something that is important. I know something that Sam uses, something that we use in other strategies, but believe it or not, it's not something I pay attention to in the bull put or bear call credit spreads. And I'll explain why in just a moment. So, oh, this isn't a good example, but that's okay. Anyway, what Brian wanted to know is, can you discuss volatility and the idea of implied and actual in selecting stocks where the actual is less than the implied? Okay. 2 forms of volatility. Implied volatility, which relates directly to the option, meaning that it's the number behind why the option is not trading at its exact Black-Scholes pricing model, which is based on the stock volatility. The historical volatility of the stock is a measure of the movement of the underlying security. Now, it's not beta. Beta is a measure of the movement of the underlying security in comparison to the S&P 500. The historical volatility is a statistical measure of the price fluctuation of the underlying, and we usually show it on the last 50 days of trading, the 50-day volatility, okay? Now, that's used in the pricing models to calculate what is the theoretical or Black-Scholes value of an option, okay? Now, the option volatility is the number that implies why the option is priced below or above, okay? So if you have what's called an IV-HV ratio, which you can screen for on Power Options, IV over HV IV, the implied volatility over the historical volatility ratio. A ratio of greater than 1 means the implied volatility is greater than the stock volatility, meaning the option might be overpriced. An IV-HV ratio of less than 1 means, of course, that the option is theoretically underpriced based on the calculations. At the same time, the Black-Scholes ratio. Now, I told you that the historical stock volatility is used to, used to calculate the theoretical worth of the option. And then that equation sort of worked backwards to say, well, the option should be priced at $1. It's actually priced at $1.20, which would have an IV-HV ratio of about 1.2, or a Black-Scholes ratio of 1.2, meaning it's overpriced. But how do they determine that? Well, they take the Black-Scholes equation, which has 5 factors in, including the stock volatility, to get the price of the option as the answer. Now take out the stock volatility from the one part of the equation and substitute the answer, what the option should be priced at, and put in the real price, work the equation backwards, there's your implied volatility. There's easier ways to calculate it, but that's just an easy way to describe it. It's why the option is not priced at its theoretical worth. So if you have an implied volatility below the historical volatility, an IV-HV ratio of less than 1, meaning it's undervalued, well, your Black-Scholes value for the option might be 1, but the actual trading price is 80 cents. Why is it undervalued? Who knows? Well, there's other factors that determine that, but you'd have a low implied volatility in that case, okay? So that's what's the implied. Implied refers to the option, why it is not trading at its Black-Scholes value. The historical volatility, the stock volatility, is just the past movement of the stock. Another way of looking at it is saying implied volatility might be a measure of future changes or future fluctuations, whereas into that as well, we might not be, the historical volatility is measure of the past. Okay, no, maybe not direct information for the future as well. But you can screen by Black-Scholes ratio. If I wanted to just look for overvalued options, I could look for a Black-Scholes ratio of the sell option for my spread of greater than 1. I hope this does what I want it to. I'm not guaranteeing it does. Okay, it didn't. So my short option here is still overvalued. Now here's something you got to be worried about. In theory, you might want to enter a credit or a debit spread where the option you're selling is overvalued and the option you're buying is undervalued. The Black-Scholes ratio or the IV-HV ratio is less than 1. But you might find these from time to time, and they're not really better trades. But now the one spread that matched the rest of our criteria is no longer here. Why? Because if one option for a certain expiration on the same stock is overvalued, the other ones are overvalued too. You're not going to have, even if they're deep out of the money compared to deep in the money, in general, if one option slightly out of the money put is considered overvalued, a lower strike put is not necessarily going to be undervalued. They're most likely all going to be overvalued because of the IV to HV ratios. Okay? Very rarely will you find a position in a spread where their option you're selling is considered overvalued and the option you're selling is considered undervalued. If it's on the same stock, they're all undervalued or they're most likely all overvalued. Okay? Brian had another question here related to this. Does Batman strategy mean anything to you? A debit spread inside a Condor? No. Just an unnecessary addition of another 2 legs, it sounds like, for that as well. In this conversation about implied volatility, and I do have to make my other comment on that. Thank you for jogging my memory, Sam. Sam says it is also on the demand of supply. That's right. You'll see fluctuations on that based on supply and demand, market maker fluctuations, future events. That's why implied volatility increases. There are a lot of services out there that say that you can't trade unless you have a working knowledge of implied volatility and you'll get hurt. To tell you the truth, I do not agree with that. I don't agree with that because I showed it, I believe, in one of the webinars here. If you have a working knowledge of options, even not considering really, it's another way of describing it, but even not considering delta, gamma, theta, and vega, you can still be very successful trading options, just using different terminology, okay? When we talked about the spreads, I focused on the idea of the probability. I equated it to the delta, but I don't use delta. This sort of is close to the delta, but it's not the same. It's a little bit different. And we know going a range out of the money. And the whole reason why I spent 10 to 15 minutes talking about the expectations of the 1 week out spreads, 2 week out spreads, and 1 month out spreads on the beginning of Wednesday's presentation was because if you have a reasonable expectation of what you're looking for, you put in a criteria set that makes sense and is reasonable for the strategy, whether you know it or not, you're already sorting by implied volatility, delta, gamma, and theta without even using the terms. Okay? Why? Because positions that have good market trends, good fundamentals, which is what we're looking for, have the delta of less than 0.25, but we use probability of greater than 75, okay, and don't have earnings between now and expiration. When I ran it and we pulled up the 4 positions, the implied volatilities were between 0.31 and 0.25. Without screening by implied volatility, I already am. When we had 4 trades that matched the criteria, the historical volatility, I think, was between 0.22 and 0.41. Pretty restrictive. But again, we showed historically that I didn't need the volatility, the theta, the vega, the gamma. I am, you could say, using delta, but I'm calling it probability. But I am kind of using delta. But they all go hand in hand. Okay? So I don't look for options that are overvalued. It wouldn't surprise me if I went back over that 2 years of trading and delved into each trade that went through that historical cycle that we traded, the 140 trades in the 2-year time frame with the 2-week out series. It wouldn't surprise me if 85% of those options were considered undervalued and still had a profit. Because I don't care if the market thinks the position is overvalued or undervalued. If it matches the criteria that I want and the proven criteria that I've seen during neutral to bullish market conditions for bull put spreads or neutral to bearish for bear call spreads, it doesn't matter to me if the market thinks it's undervalued or overvalued. If it has the credit I want, the return that I want, and the range that I'm looking for, I'm going to take that trade. Doesn't matter to me what the market thinks. Okay? All right. Let's see. Oh, yeah, and Sam was there talking about that also. Ed made a comment, and I think Ed might have signed in with a different name, but Ed, I don't know if this is the same Ed. I got a note, a comment at the end of one of the webinars from an Ed D, who has stated, asking, do you have any videos, well, this is Ed T's question here, do you have any videos on ratio butterflies like 1 by 3 by 2? No, I do not. I don't mess around with butterflies, especially ratio butterflies. I don't like butterflies. I prefer condors. So one thing I always tell customers in relation to the butterflies, whether you're doing iron butterflies, you're doing all call butterflies, all put butterflies, even broken wing butterflies, which are a little bit more safer. Sorry, folks. There we go. All right. So let's do this. All right. But here's my comment on standard butterflies. I know it's not what you're asking, Ed, but, oh, sorry, here's my comment. Butterflies give you much more kick. You know, iron butterflies give you much more kick than an iron condor because you're selling both options at the money. You still have protection in place on the outside wings. We can do broken wing butterflies, which are, you know, a little bit sort of extended here and things of that nature, which look pretty good. But here's the rub, to me personally. It's a target pinpoint strike. I can't do that. I can't, with consistent reliability, pick where a stock's going to be trading plus or minus 1% in a 5-day, 7-day, 14, 20-day period. If you can, and you're successful at that, and you have been successful at that, meaning more than 65% of your trades, you've been able to pinpoint exactly where a stock's going to be trading within plus or minus 1% every 5, 7, or every 20, or every 15, or every 35 days, you're much more successful trading than I am probably, and you don't need my help. Flat out say it that way, okay? I don't even try to do this. I don't mess around. I'll do a condor to get less credit, but to give me a wider range of profitability. Yes, the butterflies may tend to have a wider upper and lower break even, but the goal is to make near the maximum profit. You've got to pinpoint a strike price, and I'm not good at that. I'll admit it freely, okay? So I don't even mess around with butterflies, iron butterflies. Broken wing butterflies, I agree, a little bit safer. I've never touched ratio butterflies. Occasionally I'll do a ratio call spread or a ratio put spread inside of a larger trade that doesn't take that direction, but I've never traded and I've never researched ratio butterflies, 1 by 3 by 2 butterflies. I've looked at broken wing butterflies. The reason why I'm saying this, Ed, is I'm not even going to try to feign education or discussion on this topic because I literally know it exists. I literally know what the profit and loss chart looks like. Aside from that, I couldn't even tell you what to start looking for. I could see by the chart, is it relatively neutral to slightly directional? I could guess that there's probably some kind of delta construct or gamma construct you might be looking for in a ratio. I wouldn't even know where to begin. So I'm not even going to fake it. I'm not even going to put together a series unless I spent probably twice the amount of time you've spent researching and hearing about it online and make sure I've got all my ducks in a row before I could even think of discussing it as an educational topic or presenting it as a webinar. So unfortunately, no, I do not have any education. Ratio butterflies, broken wing butterflies, except for in the construct of a radioactive trade, a larger trade as well. So I'm not even going to fake that at all and try to look at that, okay? That's the idea. Okay, volatility, Andrew says, where do you find volatility and relative volatility in power options? Well, it's sort of all over the place. So Sam says he feels markets are too volatile right now, in his opinion, for those types of strategies, that there's too many wild swings. Andrew, you can see the volatility in a lot of various places. Anytime you're in a search for, let's say, credit, debit, covered call, whatever, let's go back into the search here. I'm sorry. And let's go into choose columns. Okay, we already saw that you could screen by historical volatility and you can screen by implied volatility range for the sell option and for the buy option. And you can use the Black-Scholes ratio to look for overvalued options, which is pretty much the same as the IV ratio, IV to HV ratio, my apologies. But when you click on the Choose Columns button, you can pick and choose which data you want to see in any search. All right, so I've already got historical volatility selected, and I can select the implied volatility ratio. That's between the sell and the buy. I think I already had it selected. The implied volatility is also for the short and long implied volatility. There's the historical volatility as well. So let me just go ahead and I already had them there. So you can choose them in the columns. I didn't have them next to each other. So I have, there's historical volatility of 0.25. You can have it in the search. Okay. Now, when you go to the research tool for the stock or the option, I'm just going to go to the stock research tool, Andrew, from the more information button. We show you all of the relative data that we have for each individual stock, of course. And over on the right, we've got your 20-day volatility, 50-day volatility, 100-day volatility, 250, put call volume ratio, put call open interest ratio, so on and so forth, and more and more. The SIV is also shown here. This is the average implied volatility of the near-term in-the-money and out-of-the-money calls and puts. So it's an average of all the near-term options implied volatility, which in most cases will relate pretty closely to the 20-day moving average. With options, just the next 1 or 2 cycles out, including weeklies. Where you'll see this shift is if you have earnings coming up, this might go, the SIV might go up to maybe 0.38 or 0.4, and the 20-day volatility might still be at 0.28. Because remember, historical volatility, 20, 50-day, that's what's happened in the last 20 to 50 days. SIV, the average of the near-term implied volatilities for the options, is current. Okay, it's the average of what's the expectation, what's the forward-looking risk or the forward-looking speculation. I'm sorry, I wanted to go to research again. Now here's something many of you might not have seen. We're looking at a bull put credit spread search, selling a 160 put for September 8th on Alibaba. I go to research, I can go to long put or short put research. I'm going to go to short put research. And it shows me all of the data for the option, including, there's the IV-HV ratio, it's 1.2, so it's 20% overvalued compared to its stock volatility. And the implied volatility range is 5.6. What does that mean? The percent IV range is where the option's implied volatility is now, 0.28, 0.80 compared to where it has been over the life of the option. And over the life of this option, since it was released on the market, the implied volatility has been from 0.28 to 0.43. So right now at 0.288, it's in the lower 90th percentile, 94th percentile of its implied volatility range. And that's interesting. I mean, one might consider, even though it's considered overvalued, it's at the lower range of its implied volatility. Okay? And of course, another thing we do at the bottom is you can actually see a chart comparing implied volatility. So this is the implied volatility for this position. Now, why is it up here? We see it's at near that high. It was probably at 0.43 intraday here, and then dropped back down. What happened here? Probably tell you that 816 was probably somewhere between 814, or well, I might even say 811 to 816 was the last earnings date for BABA. That's why the volatility, it doesn't seem like a big drop, but believe me, that is. From 0.38 or 0.43 down to 0.3. It's a 0.28. That's a pretty big move. 10% movement. It's a 30% volatility shift if you think about it. But let's go back to the stock detail. Last earnings were on 11.1, so we could assume that maybe around 8.1 or 8.3. So maybe this actually came out before the earnings. It was a different movement that was related to that as well. Okay. All right. Let's see here. Okay. Oh yeah, Sam was commenting that stocks like AAOI has a high option premium, and Adams Pharmaceutical had at the money calls and puts that were $3 to $4. One of them is going through a phase 3, I think. One of those pharmaceuticals has a phase 3 or phase 2 trial coming up, I want to say in the next 20 days. Well, that's when the ruling's in theory supposed to come out, is sometime within the next 22 days. It could happen in 5 days, it could happen in 10 days, it could happen any time in between there as well. All right, so that's the relation. You talk about implied volatility, historical volatility. When you're looking or researching an option either on the chain, let's say, or from the search, remember you can go to that research tool for the call or the put option, the call research or the put option from the research link, and you can compare the historical values of the different options. And it's not just implied volatility versus option bid, by the way. You could see a chart over the life of the option for Black-Scholes, option volume, time value, delta compared to option bid, and more on the comparison chart here. And it's based on not, customers ask me, is this based on the year-long history of the option? No. Most options don't exist for a year. This is based on the actual lifetime of this option. I'm not going to project. We're looking here at the 148 call, so you can say, oh, well, over the last, where was the 148 call 12 months ago? 12 months ago, Apple was a completely different animal. The implied volatility, the delta, the implied volatility range of the 148 call when Apple was at 109 or 110 is a completely different animal than looking at this current option at 148 with the stock trading around 149. So giving me this, well, what is the 1 year volatility for this option? There isn't a 1 year volatility. It's only existed for 3 months, or 2 months, roughly. That's what's important. What has it been over the actual trading period of the option? Not saying, oh, well, the 148 12 months ago had a volatility of only 0.005. Yeah, it was 20 points out of the money, 30 points out of the money. It's a completely different scenario than what we're looking at today or what we've been looking at in the last 3 months. That's why we use this percent implied volatility range related to the lifetime of the option rather than this idea of what is the 1 year volatility of a particular option, because it's a completely different animal 12 months ago. So anyway, that's just a little bit of a blurb there also. All right. I do believe I have covered everything. That is, I've covered everything that was asked. I think I might have missed one question from Brian. Brian, I think you had an additional question about volatility. I think it disappeared from the question pod while we were scrolling through some of the answers there. So I didn't see it. If you think about a question that you asked that I didn't address directly, let me know, or might have addressed it using one of the other series as well. I do believe I got all the questions that came in from the two that left. Terry V and Chang left too, but I believe I answered those questions, so that'll be available in the archive also. All right. So that being said, I think we've got it. And if I think of anything else, believe me, I'll let you know. But in any case, here we are at the end of part 4. Remember, if you haven't done so yet, take a look at some of the search tools we looked at today, profit and loss charts, setting alerts in the portfolio to help you track and manage your positions. Hey, those detailed research tools that show you those charts of the past, implied volatility, delta, gamma, and other option criteria going back in time. You want to delve into that deep of research and analysis, just take a simple test drive of Power Options. Just go to powerop.com, first name, last name, email address, and you'll have access for 14 days, okay, to all the tools, 20-minute delayed quotes, everything I showed today, and more, completely free, no credit card required or anything along those lines. Of course, after that, our subscription levels, we do offer an end-of-day service where the data is updated at the end of the day. That's only $40 per month. The 20-minute delayed service is $60 per month, and you get a discount if you go to the yearly subscription. I didn't showcase the historical tools today. We talked a little about the results using the historical data. But if you do the 20-minute delayed and upgrade to the historical tools, which allow you to do historical searching in using your criteria, similar to what we saw in the strategies, similar structure, historical options chains, and historical search by symbol, which data goes back to April of 2006. It's only $40 more. So the 20-minute delayed service with historical access is $100. And of course, we do offer the real-time service. It's $120 per month, and everything, historical data, access to the the programmer's interface, for example, and the historical data is $160 per month as well. Now remember, if you want to see other free information, the 4-part series is available both on YouTube and on the Power Options webinars page. 4 webinars we did today: debit spreads versus credit spreads, how to be successful at spread trades, managing your spread positions, and our wrap-up today on the open discussion. You'll be able to check that out on the webinars page, powerop.com/webinars.asp. They'll also all be available on the YouTube channel as well. And check those out at any time. All right, so right now, coming up for next week, I don't have any planned material, but you'll be notified soon what webinars we're going to start hosting for next week going forward as well. And if you think of any questions later on, send me an email at any time. You can reach me at support@powerop.com. Of course, you can also, if you have questions about the radioactive trading techniques, you can send me an email to support@radioactivetrading.com. Remember, you can also call us during market hours, 302-992-7971, located out here in northern Delaware. So you can reach us during market hours. I'm actually usually in the office till about 6:15 p.m. Eastern Time. And those of you that are current trial members or subscribers, remember, you can schedule a coaching session at any time. Just go to the free coaching link under the main home tab of your account, pick a time that works for your schedule, and Ernie or myself or one of the other experienced staff members will spend 35, 45, maybe even up to 65 minutes with you going over the tools on the site and answering any questions that you have. Just another benefit of being a subscriber or trial member to Power Options. Well, I guess that's going to be the last words we have on our 4-part series on spreads. Thank you all for joining me this week, and especially thank you all for joining me here today. I hope everyone has a fantastic weekend. As Sam mentioned, I hope any of you who are out in Texas and in the path of Harvey, you take care and you take cover, and hopefully it's just a lot of rain and hopefully not a lot of damage for you. But we'll be keeping an eye on you here as well. So take care and good luck. Everyone have a fantastic weekend, and we'll see you soon. Good night.